In this episode of the FXTM educational series, we're going to be taking a look at fundamental analysis. Now, I would suggest that fundamental analysis basically falls into three categories. There are economic factors, political factors, and geographic factors. Now, the one that we're going to be dealing with most often would fall into the general category of economic factors, and I would suggest that we could further subdivide this into three key components. So there is anything that's going to affect interest rates or relative interest rates between one currency versus another. There are also factors that are going to affect growth expectations, which is an important concept that we would assume that anything that affects growth expectations is probably also going to affect interest rate expectations. In fact, most fundamental factors are probably going to affect interest rate expectations at some level. And then finally, trade. So let's look at three charts that help to explain how trade, interest rate expectations, and economic growth numbers can explain why the trend was so robust. And we'll start with the euro to the US dollar. In June 2014, the European Central Bank cut their target interest rate to 0.15%. Now, this is going to further widen the differential at the time between interest rates in Europe versus those in the United States. And we would expect that this is probably going to be in favor of the dollar, and that certainly is the direction that the trend was going. By the time we get to September of 2014, the European Central Bank further cut rates to 0.05%, making that differential a lot greater, and we see the trend further favor the US dollar for a few more months. In 2014, the Japanese economy had hit a low in terms of a trade deficit, but then began to recover, and in 2015 they flirted with a surplus and then finally went into surplus in 2016. We can imagine that this improvement likely contributed to that robust trend from 2015 through 2016. Now let's look at an example in real time. I have a 1-minute chart here that is streaming for the euro to the US dollar, and the NFP report for the month of September in 2016 has just been released. Now, the numbers were underneath expectations, so we would think generically this probably should have a negative impact on the dollar. And you can see the initial reaction is in favor of a stronger euro, weaker dollar. Now, anytime a report is released where the actual numbers are worse than expected or perhaps better than expected, we shouldn't be surprised to see some back and forth pretty fast. And in fact, you can see that happening during the initial reaction here to the NFP report as well. Now, I've jumped ahead a little bit here so you can see that after the initial whipsaw or back and forth on the euro to the US dollar, we finally get a resolution in favor of the euro, at least temporarily. Now, economic reports like the NFP report that we looked at, we know about them in advance, meaning that we know when they're going to be released in advance, and you can find them on the economic calendar. So here's an example of what I mean. And as you can see, the economic calendar is divided into several columns that will help you to understand what currency is likely to be affected or what economy is releasing that particular economic fundamental announcement, the anticipated impact or volatility impact that is going to occur, what analysts expect the announcement to actually be, which we can then compare with what it actually is, like we saw on the NFP report. The more dramatic that difference is, the more likely it is we're going to see a large reaction, at least in the short term, in the currency market. And then finally, we can see some data about what that announcement actually was the last time. Now, the second category of economic fundamentals are political, and I would divide this into basically two categories here. So generally, when we're talking about political things, we're probably talking about policy. Now, this could be monetary policy or fiscal policy. So as an example, changes to the Fed's target interest rate would be an example of monetary policy changes, as well as stability. Now, this one here, I think we have a great example of that in 2016 with the Brexit, when the UK left the European Union. So that affected the value of the British pound versus any other currency out there. And in particular, it affected the value of the British pound versus the euro and the US dollar. In fact, let's look at two charts that explain how these two factors of political fundamentals can affect currency pairs in real time. In May of 2013, Ben Bernanke began hinting at a taper of the bond buying program, which turned into reality in June of 2013 during that FOMC meeting. Now, what's important to recognize is that no changes to the bond buying program were made at the time, but there was a resetting of expectations as to when those changes would actually occur, and therefore we saw the dollar begin to rise dramatically after that announcement. As I mentioned before, the Brexit vote would have been very difficult to predict, but it certainly did lead to fairly extreme levels of volatility, with the pound losing value against most other major currencies. The last fundamental factor, which should be geographic factors, is going to be very difficult for us to predict, and it might include things like drought or something of that nature, or, for example, the tsunami in 2011 that affected the Japanese yen. In fact, if we look at a chart of that, the initial reaction may seem a little bit confusing, but in fact, geographic factors like this can have very unpredictable effects on currencies. As you can see, initially the yen actually strengthened against the US dollar, as investors may have been looking at it as a safe haven before beginning to actually weaken. Geographic factors can be very difficult for us to predict, but it's important for us to think through the likely effect that it's going to have on the currency market. Fundamental analysis can be challenging, but it's important to understand the underlying factors that are largely responsible for the long-term trends amongst currency pairs.